Well, as the summer of 2023 continues to sizzle across the U.S., so does Witham's real estate tax services, advisory, and strategy offerings. Mike Hurwitz has shared in prior podcasts many of the tax saving strategies afforded the real estate industry and investors. We're very, very fortunate today to be joined by Kimberlee Murphy from the International Group. She leads that group and in many, many cases does a lot of planning for non-resident aliens and related companies because they want to invest in real estate and take advantage of the markets. Well, it's a little different for a non-resident alien versus U.S. citizens and the like. So let's just jump right into it. You guys ready, Mike? Kimberlee?
Yep. Oh, yeah.
Yep.
All right. So a couple things. Don't ruin a great investment in the real estate arena. Know before you go, reach out, minimize your tax, increase your return on investment. So, Mike, This term blocker sounds like a game out there. It sounds like kids playing something like on the field. Tell me about what a blocker is in the real estate industry.
Yeah. So a blocker is really just a C corp, and it really is what you're saying. It's a blocker. And it really prevents things from getting through. And take a step back, blockers really rose, and the use of them rose in the early 90s when limited liability companies were enacted and started to become more of the mainstream investment for real estate. With the limited liability for owners, the flexibility in the economics, and more so the pass-through, the single layer of tax. Blockers afforded a way for tax-sensitive investors to invest in real estate in a tax-efficient manner. So let me digest that a little bit for you. With the pass-through, you have a partnership that passes through the income through to the investors. These tax-sensitive investors, whether it's an exempt entity, they have what they call unrelated business taxable income. That type of income from a trade or business would flow through to them. And if it's not substantially what their exempt purpose is, they would be taxed on it. Same in the foreign context. If a foreigner invests directly through a partnership, that income passes through to the foreigner, and that foreigner then is subject to effectively connected income, FIDAP. They have tax on that. So what the blocker does, simply said, is a blocker is a U.S. corporation that really enables these foreigners, these exempts, to invest in these vehicles in a tax-friendly manner. What ultimately happens then is the corporation pays the tax and distributes out dividend income. So the blocker converts this kind of trader business income, ECI, FIDAP, unrelated business income, into dividend income, portfolio income to the investor.
It also importantly, a lot of foreign entities don't want the IRS to have access to them as a separate entity. So it blocks the IRS from getting information on the foreign owner and limits it to the U.S. entity. So it blocks that information as well.
So many foreigners are afraid of the IRS and the complexities of the U.S. tax system for sure. Yep. All right, Mike, that's good. There's a whole different language we need to learn, and a lot of initials are used like ECI and FIDAP. Kimberlee, maybe you can help us explain some of the sources of income and the terminology associated.
Sure. So ECI stands for effectively connected income, and that means it's effectively connected with a U.S. trade or business. So it's an active trade or business in the U.S. So oftentimes when you have someone investing in a U.S. business, that's an active trade or business. FIDAP stands for fixed or determinable annual and periodic income. So when you have rental income, interest income, dividend income, that's FIDAP, and it's kind of set and annual and periodic, and that is usually subject to withholding taxes, whereas ECI is subject to graduated income taxes because it's considered investment income. Now, real estate kind of falls in between sometimes because if it's just rental income you're getting, it can be FIDAP. But if it rises to the level of being a business, which often if you're investing through a partnership, you want it to be that effectively connected income because then you can make elections and you can be taxed on the net income instead of the gross rents, and you can then be subject to tax at graduated rates instead of a flat withholding rate. So those are important distinctions.
So a lot of individuals want to invest in U.S. real estate. So if I'm a Australian citizen and I need a vacation home, say in Florida, and I'm going to buy that property with or without a blocker, what is being created there? FIRPTA or ECI?
Well, if you're not if you're not going to rent it out, you're not creating either. You're just investing in the real estate.
Sure.
If you're going to rent it out and you're just getting gross rents, those gross rents are considered FIRPTA unless you make an election to be treated on the net income. So it's going to be very important that you set that out right from the outset. Right, Michael?
Absolutely.
Yeah.
I will say one other thing. The income that is being distributed out to the foreign shareholders of these blocker corps is subject usually to reduced tax rates due to the treaties. I don't know if you want to expand on that a little bit, Kimberlee, the use of the treaties.
Right. So if you are a member, if you can rely upon a treaty, for example, the U.S. has a treaty with Australia. So if you can rely on that treaty, for example, if you set up a blocker and you set up a U.S. corporation and that corporation pays dividends to a treaty member, instead of paying, a non-treaty member would have withholding at 30%. But if you're a treaty member, Australia, I can look it up, but it's probably 15%. So you'll pay a 15% U.S. withholding tax, and then you'll pick up the income in Australia, pay their tax rate, and then get a credit for the 15% tax withheld in the U.S. So it's a way to reduce the overall tax.
Sure. Just to kind of clarify the blocker versus a non-blocker, again, I'm an Australian citizen, and I have a choice. I can invest in an LLC that has invested in U.S. real estate directly, or I can go through a blocker corporation. Why do people still invest directly into U.S. LLCs? And what are the tax issues?
Well, if you're directing directly through an LLC, you're going to have ECI or FIRPTA. You're going to then file a U.S. tax return. And many of the foreigners don't want to file the tax returns. You're then going to be, not only filing tax returns, but subject to the U.S. tax, direct tax, opposed to a treaty rate that might be a lot lower.
Right.
Yeah, and rumor has that income that might be allocated to me, even though there's no cash distribution, it's still taxed.
Right.
Correct.
If it's in an LLC, it will be taxed to you regardless of whether it's distributed. Versus if it's in a corporation, the corporation might pay tax, but then it's not taxed to you until it comes out of the corporation.
Great.
Yeah.
People go into investments with an ultimate exit. And we know that certain sales of U.S. stock is exempt for non-resident aliens. So let's just say we've used a blocker. The real estate is a major investment. What happens? What's this term FIRPTA? What is this taxation when I want to get out and cash in my appreciation?
Right. Another one of those terms we need to define, FIRPTA, the Foreign Investment in Real Property Tax Act, FIRPTA. So if you have a U.S. corporation that has a majority of its assets as U.S. real estate, well, guess what? Countries really get sticky fingers when it comes to their real property. They don't like it when their real property goes without tax. So if a corporation or any business entity has a majority of its assets as real estate, it says, we don't care that you're selling stock. That's another term, a usurpee, a U.S. real property investment. And that is going to be subject to FIRPTA. That means that it's going to be subject to U.S. tax, even though you're selling stock in a corporation. And it's going to be subject to withholding tax. So even though you're selling the stock, it will be subject to tax, and it's going to be subject to withholding tax at the time of sale, so that the U.S. is sure to get that tax. So
there is one big exception to the FIRPTA withholding, and that applies to what they call domestically controlled REITs. We spoke about REITs in one of our earlier sessions, predominantly a mutual fund that holds real estate investments. But if you sell domestically controlled REIT stock, basically the ownership of the REIT stock is less than 50% held by non-U.S. shareholders, that sale of the stock is exempt from FIRPTA. So you'll see a lot of the foreigners invest through some of these, what they call D-REITs, and that's their exit plan there.
Right.
Very interesting.
But in your example, Dave, if I'm an Australian citizen and I decide to buy a vacation home in Florida and I'm renting it out and I put it in a corporation, and then I decide it's time to sell my Florida investment because Miami is sinking, um, and I sell the corporation, I'm still going to pay U.S. tax, even though I'm selling stock in a corporation.
No way
And they're
around.
going to collect, and my buyer, better beware, my buyer is going to have to withhold the tax on that, even though they might be buying stock in a corporation.
So we're about to buy some real estate. I just moved from Australia. Now I'm in the UK as a UK citizen, and I want to go back to Florida. And I can either use my own capital, my own savings, or I can borrow money, and or I can lend money to this U.S. Block Group Corporation. I heard there's something about portfolio interest, the deductibility, the exemptions. Anybody want to address that, Mike? Let me start with you.
Well, portfolio interest, there's a big exception out there for foreigners that loan money to U.S. The U.S. loves bringing in foreign money for investment purposes. And back in the 80s, the early 80s, they came up with this portfolio interest exception for certain types of debt, whether they're registered or bearer obligations. Basically, the debt is paid to a foreign person outside the United States. So what the exemption is, it's a lot of the blocker corps, not necessarily individuals, but a blocker corporation. What will happen is the foreigner will not only put equity into the investment, but they'll also loan money directly into the investment. So it's another way to participate in the real estate in an indirect manner. And then when they repatriate the debt service, the payments back to the foreigner, that interest is not taxable, no withholding on that. And so you do a few things by that. One is the individuals that aren't necessarily covered by these bilateral treaties for the reduced payment, they get there's no withholding on them at all. And then secondly, it reduces the corporate income. Right, the corporation picks up kind of rental income from the lower tier entities, and now all of a sudden they have this big interest expense that they're paying back to the foreigner. So you just got to be careful who the foreign corp pays the interest to. It's got to be a foreigner. I believe individuals do not count. Foreign controlled corporations don't count. There's certain types of entities that have to receive the interest.
So you're saying there's a portfolio interest exception, but then there's exceptions to the portfolio interest exception. It sounds very confusing and circular. So
well, that's why we have Kimberlee's phone number on speed dial whenever we're doing foreign transactions. You
know before you go. Make those investments with your eyes wide open.
You need to be careful when you're raising capital and building out the capital stack. And once you hear there's a foreigner involved, you want to bring in, we bring in Kimberlee or some of her staff that work with her to look over the documents to make sure you get there's all kinds of compliance forms you need to have. So for this portfolio interest exception that we're talking about, you really want to get a W-8. And the W-8 form says, hey, we're foreigners and we're going to be receiving this interest. And, some of the other things that we mentioned before, the ECI and FIRPTA, there's other filings. I don't know if we want to talk about that.
We can get into the forms, but what's important to know is that if you're paying that interest and you think you can rely on the portfolio interest exception and you don't have the forms in place and you can't, the IRS isn't going to go to who you paid. They're going to go to you. So you might have paid without the portfolio and, thinking you can claim it. And if you can't, you're going to have to pay what you've already paid, plus the interest plus the tax you should have withheld, plus interest on it. So you need to be very careful that you've dotted your I's, crossed your T's, gotten all the forms, because they're not going to look to who you paid. They're going to look to you. So let's talk about the forms. So the W-8 is absolutely key. The W-8 it verifies that you're paying a foreign person, verifies that that you can rely upon any sort of exception, a treaty exception, a portfolio debt, a portfolio interest exception, and without that W-8, you are required to withhold 30%. That is a new thing under FATCA, the Foreign Account Tax Compliance Act. So FATCA says if you don't have documentation in your file that the person is foreign, automatically withhold 30%. So you've got to make sure anytime you're paying a foreign person, you have a W-8 in the file to prove that they're foreign. When you get into buying and selling or buying real estate, you have to make sure there's a whole series of forms called the 8288s under FIRPTA to make sure you have those forms in place to talk about whether they're subject to withholding, if there's some exceptions to the withholding, and then reporting all of that to the IRS when you're buying real estate from a foreign person. If it's subject to FIRPTA, if there's exceptions to FIRPTA, you want to make sure you have all of those forms in place too.
And then the other form I just would like to mention is the 1042.
Yeah.
As you're doing the corporate blocker entity that ultimately is paying out dividends or return of capital distributions from the blocker entity to the foreign entity, the 1042 will, it's like a 1099,
Right.
but it's a 1042 to the foreigner, and you would have, some different codings up top, whether it's a return of capital, whether it's dividend income, what type of income it might be. So.
Right. And if it's subject to withholding, the withholding is there. And if it's not subject to withholding, the exceptions are reported there as well.
The code,
so,
the code, right.
Right. So even if it's just a payment and you think it's not subject to withholding, why do I need to report it? Report it, because you want to make sure you're reporting and you're saying it's not subject to withholding because of this reason. Very important.
Well, I think the best advice you guys have given is I've gone from Australia to the UK. I'm coming to the US to avoid all this complexities on the filing forms. But why don't we kind of wrap up here? A simple structure, just kind of bring this all home, Mike, Kimberlee. Best way for a foreigner to invest in the US, or is there just not one way?
I'll start from the investment going one way, and then Kimberlee can come back down the other way. Look, I think the best way to buy real estate, rental properties in the cities, data centers, hotels, whatever it might be, is through a partnership, as we've discussed. Great flexibility in the economics and sharing things. So you're going to have some sort of pass-through entity, partnership LLC, maybe even a GP. If you're in certain states, you might have to have a GP, but most states now allow the LLC. Above the LLC, as the partners in the limited liability company, generally you have, the sponsor will be in there, getting the back end promote, getting the carried interest, all those things. And then if you're going to have in your capital stack a foreigner or an exempt, you're probably going to have some sort of corporate blocker. Because I like REITs, because most of the time we're buying real estate, I really like the REIT because, as you know, the REIT doesn't have the double taxation that passes through as well. So the REIT is a corporate blocker, whether it's an 1120 corporation or a REIT. They do the same thing, but the REIT blocker gives you two extra benefits. One, you don't have that corporate layer tax because the distributions, dividends, pay deduction wipe out the taxable income. And secondly, it gives you that added disposition strategy of selling the REIT stock if it's domestically controlled. So your typical investment would be property, maybe in a disregarded entity owned by a partnership or LLC. Above that, is your partners, whether it's a sponsor or, in another partnership, some sort of blocker corp for your foreigners and exempts. And then they might be coming through, Cayman, out in Australia, how they're coming in. I don't know if you want to say it differently, starting at the foreign investors, because that's where you start with. But I think it's the same, right, Kimberlee?
Yeah, that's a great investment strategy. I think, someone looking to invest into U.S. real estate, but often we're dealing with individuals who want to come in and they want to come to Florida, or they want to come to Maine, or they want to come somewhere where they can buy a single property that they will partly use and partly rent. And that's a little bit different. And that's where we would see them buying into their own single member LLC. And then we get into slightly different issues, and you'll have to look at FIRPTA and stuff. But if it's just purely investment driven, I love your strategy.
Yeah, great.
You're not going to get to use that piece of rental real estate if you come in through the REIT.
Michael, as usual, great real estate advice. Kimberlee, the international arena on top of real estate is very interesting, but I know where to go when we need experienced real estate tax advice right here. So Thank you for your time today and insights, and stay tuned.
Thanks, Dave.
Thanks, Dave. Thanks, Mike.
Bye-bye, guys.